So this is the start of chapter 4, and we're going to be introducing a concept called debit and credit. Now, you've heard these words before. You've probably even heard of debit cards and credit cards, and the reason those are named the way they are is because on the bank's ledger or balance sheet, they're debits or credits to them. For most people, we don't think of it that way. And in fact, in accounting, you need to think of it differently than you've ever thought of before. Okay? So, what you need to understand is that the word debit simply means left, and the word credit simply means right. That's it. It's like port and starboard, okay? It just means left and right. Now, what are they left and right of? They are left and right of the T account. So what we do is we form this T account right here. And on the left-hand side, we have debits. And on the right-hand side, we have credits. That's it, okay? So all accountants have these. They have papers drawn up with T accounts, or whenever they're doing work, they put T accounts on things, and that's how they do it. So we've got our debit on the left, and we've got our credit on the right. Okay, so we've still got our basic accounting equation, assets equals liabilities plus equities. Underneath that, we're going to have debit and credit, debit and credit, debit and credit. And so that assets are going to have their own T account with debits and credits. In fact, each asset will have its own, but we'll get to that eventually. Liabilities are going to have their own T accounts, and equities are going to have their own T accounts. Now, to make it simple, we're going to start with just one for each, all right? And there are certain rules that you will simply have to memorize. So here we go, okay? Under assets, they increase with debits and decrease with credits. So if we get money to put in the bank, we put it on the debit side, and that tells everyone else that it's an increase. And if there is money coming out of our checking account, then we put all things coming out of the account, decreasing our checking account, over here under credit. So if we put $2,000 into our account, we put it over here under the debit side. The reason for that is that all assets go up with debits. You're just going to have to memorize it. The thing about debits is that it's the left-hand side of the T account, and that will increase all assets. If we write a check for $1,000, that's money going out of our account. That will decrease an asset by $1,000, and we put it under the credit side. Okay, so this is all new to you, so I'm going sort of slow here and step by step, and even then you're still going to be like, what are debits and credit cards? No, it has nothing to do with that. Just think of it as left and right, and for assets, left is up and right is down. That's it. So if you're looking at this, you're going to notice there can't be any negative numbers anymore. There's no such thing as having a negative number anymore in the class. All right? Because if you want to show a decrease, a negative, $1,000 coming out of our checking account, you put it in the credit side, and it is a decrease of $1,000. And so everyone knows that this, on this right-hand side for an asset, is going to be a decrease. Anytime we want to raise an asset value, we put it on the debit side. Every time we want to drop an asset value or decrease it, we put it on the credit side. That's all you got to do. This chapter is about working with this over and over and over and understanding these rules. Okay. Now, as we go across to the other side of the equal sign, what we're going to find is that everything is reversed. So on the other side of the equal sign, liabilities decrease with debits and increase with credits. Okay? And owner's equity decreases with credits and decreases with debits and increases with credits. So on the asset side, it looks like this. Debits increase, credits decrease. And when we go to the other side, they just do the opposite. Credits increase and debits decrease. Okay? Like this over here, like that over there. So that if we put $2,000 into our checking account in this first example here, remember we always have to have a minimum of 2 entries. This is double entry accounting. So we know that if we just add money to our bank account, that's going to increase an asset. That's also going to increase owner's equity. And so how do we increase anything over here on this side of the equal sign? Increases are with a credit. And there it is. So we have 2,000 as a debit because assets go up with debits. And we have 2,000 as a credit for equity because credits make things increase on this side of the equal sign for liabilities and equity. So here's the thing. Every time you make these 2 entries, you will always have a debit and a credit. You could have multiple debits and a credit or multiple credits and a debit, but you always have to have a debit and a credit. So as you go through here, I would strongly suggest that every time you do this, you do the easiest one first. Like cash in bank. Oh, okay, I know that's an asset and it goes up over here with a debit. So you've already narrowed it down. Now you're just looking for a credit. And I can't increase a credit, so it's not another asset if I put cash in bank. It's got to be owner's equity, and I know that goes up with a credit over there. There's my credit, there's my debit. I've got both. It's on each side of the equal sign, so it both balances. We're good. Okay? So that's the big leap here in Chapter 4. You're going to be using debits and credits. And in fact, we're going to practice doing this over and over and over until you get it. That's really what Chapter 4 is all about. Okay? Debit, credit. Practice it. All right, so here we go. We wrote a check for $1,000. And if we write a check, that's decreasing, and we know that decreasing an asset like cash in bank is going to be a credit, so we're looking for a debit somewhere. So we paid $1,000 for rent. We remember rent affects equity because it's just a service. So if we want to decrease our equity, see, we lost $1,000 there, so it lowers the value of our business. Decrease equity is with a debit. So we have a credit, we have a debit, it's on either side of the equal sign. We're good. Okay, let me show you something real quick. In your book, if you open up the back cover, you will find where it says Rules of Debit and Credit. They are right there in the back cover. If you open it up, these are the rules. For all the chapters we're going to do, you need to memorize these things and commit them to memory. But if ever you get confused, especially at the beginning, you should do your worksheets with this open. Open up the back cover of your book, and there is the rules to debit and credit, because it is so often needed in the early stages of the class that they simply put these in on the back cover of the book, so you could just reference them all the time. All right? So that's what we're going to be committing to memory. Now, next thing you need to understand is that for assets, the debit side over here is the normal balance. Normal balance. What that means is that when we total these things up, we're going to put it on the debit side. So at the end, and this might even be in the chapters 7 and 8 and 9, we'll get to it, but you're going to see the words normal balance. And so if we total these up, we know that this is like a negative. We don't have to put negative numbers there. We just know that we have this many decreases in our checking account, and we have this many increases in our checking account. So if we were to total them up, like this is a plus 2,000 minus 1,000, then our normal balance would be 1,000. We put 2,000 in, we wrote a check for 1,000. What we have left is 1,000. We enter it in on the normal balance side for assets, and that is on the debit side, and there's your total. So imagine if we had like 50 entries for this T account, and we'd ask the question, well, how much cash do we have? Well, we total up all the debits, because those are positives in this case. We total up all the credits, those are like a negative, find the difference, and we put it over here on the debit side. All right? Now, if by some chance you have a negative, you probably did something wrong. Otherwise, you just overdrew your bank account, and you're going to be in real trouble with the bank because now you've spent more money than you actually have. Which isn't theoretically, I mean, it's theoretically possible, but it isn't practically possible because the bank would cut you off and say, hey, not sufficient funds, and then, you know, you get a penalty and all that kind of stuff. So, you should always have a positive, and it'll be on the debit side. The normal balance on the other side of the equal sign is, of course, the reverse. So the normal balance for liabilities and equities are going to be on the other side. Okay, so I'm just going to put normal balance, normal balance. And so those are things you need to just commit to memory. All right? So if you ever have to total up T accounts, you draw your line after totaling them, and you put your normal balance on the credit side over here for these two, and you put it on the debit side for all assets. Because in theory, debits and credits will match. If you total up all the debits on here and you total up all the credits, no matter which side it's on, they'll be equal if you did it right. Okay? So your lefts and your rights will all balance out. So your debits and credits will match. So if you total up all these and put them on the normal balance, and you total up all these and put them on the credit balance, even if you do the totals and then you look at the credits and debits, they'll still match if you did it right. Okay? It'll be different numbers each time, but the two you get in the first case will be the same. The two you get in the second case will be the same. And in fact, if you were to total up all the normal balance for assets and all the credit balances for liability and equity, they would be equal too. So there's three ways that you can check it. All debits and credits, all normal balances to normal balances, and assets equals liabilities plus capital. There are multiple ways you can check it, and they will all come out to be equal numbers if you did it right. Okay? So this is debit and credit, and you want to open that back cover of your book, and you want to commit those things to memory. And then when you start doing the worksheets to practice, you're going to run into some trouble. That's okay. And you're going to look back again. You're going to say, oh yeah, oh yeah, oh yeah. And pretty soon, it's going to start rolling, and you're going to get it. All right? So a lot of practice in Chapter 4 on these things.